A recession predictor built inside the Federal Reserve has matched every downturn since 1950, and it is moving toward its trigger zone. The warning signs are already appearing, but do they point to a real recession? Let's decode the data and build a practical plan that protects you either way. The indicator is called the Somme rule, created by economist Claudia Somm while she worked at the Federal Reserve. It tracks the 3-month average unemployment rate. It triggers when that average rises half a percentage point above its lowest level during the previous year. Since 1950, that trigger has coincided with the start of every recession. That record gives the indicator a 92% accuracy rate across 7 decades of data. The logic is simple. Layoffs usually begin gradually before they become obvious. As businesses cut jobs, unemployment starts rising before the headlines fully catch up. The unemployment rate fell as low as 3.4% in April 2023. Since then, it has climbed gradually from that low. That slow climb is exactly the kind of deterioration the Somme rule is designed to catch. But unemployment is only one part of the picture. The Treasury yield curve compares long-term and short-term government bond rates. It inverted before each of the last 7 recessions. An inversion happens when short-term rates rise above long-term rates. That pattern signals that lenders expect economic trouble ahead. Think of the yield curve as a weather forecast for the economy. When short-term lending demands more payback than long-term lending, markets are preparing for slower growth. The New York Fed's yield curve model currently puts recession odds within 12 months at roughly 21%. That level is elevated compared with normal times, but it remains below the 30 to 50% readings seen before the 2007 and 2019 downturns. The warning lights are on, but the economy is not yet in the red zone. That means there is still time to prepare before fear takes over. Economic indicators do not operate in a vacuum. The people controlling policy can change how every signal plays out. In 2026, Kevin Warsh took over as Federal Reserve Chair. His first months broke sharply from the tradition markets had learned to expect. At his June debut press conference, Warsh said forward guidance was not well suited to the moment. In plain language, the Fed would stop clearly signaling what it planned to do next. That means markets can no longer price in the safety net they once counted on. For 15 years, investors relied on Fed signals to anticipate rate cuts. Without those signals, the market is flying blind, making preparation more important than prediction. The June meeting also exposed a committee deeply divided over inflation. Some officials expected prices to cool as gas prices settled and tariff effects faded. Others feared that AI demand, conflict in the Middle East, and trade policy could keep inflation elevated. A sudden jump in oil prices reshaped the outlook in early 2026. Higher oil prices raised transportation, manufacturing, and eventually consumer costs. That leaves the Fed with a nearly impossible choice. Cutting rates could support growth, but it could also push inflation higher. The Fed may be forced to raise rates instead of cutting them. That would reverse what many investors expected only 6 months earlier. The so-called Fed put may not arrive as quickly during the next downturn. If growth weakens while inflation stays sticky, the economy could face stagflation. The Fed would then be fighting rising prices and a shrinking economy at the same time. That is the kind of trap that crushed the 1970s and still haunts modern central bankers. History shows that recessions follow patterns, but each one takes a different form. The real lesson is that indicators reveal direction, not the exact date of impact. The 2008 collapse grew from a housing bubble. The 2020 crash came from a pandemic that froze the global economy. The 2001 downturn followed a wave of technology speculation. Each crisis looked obvious afterward and nearly invisible before it began. The current setup does not match any of those episodes exactly. AI investment is keeping some sectors hot while others cool. Geopolitical supply shocks are adding inflation pressure from outside the economy. Labor market changes are also making the Somme rule harder to read than usual. The 2020s have shown unusually long gaps between yield curve inversions and actual recessions. The signal may still matter, but its timing is harder to pin down. People who built cash reserves and cut debt before 2008 weathered the storm better than those who panic sold later. The exact month matters less than having defenses ready before the storm. Start with an emergency fund. Most financial advisors suggest 3 to 6 months of essential expenses in liquid savings. Given the current volatility, 6 to 12 months is a smarter target. Keep that money accessible instead of locking it inside investments that may fall when you need cash. Your emergency fund is the floor that protects the rest of your plan. It can stop you from selling investments at a loss when income falls. It can also keep you from taking on expensive debt during a difficult period. Next, pay down high-interest debt, especially credit card balances. Lower balances can improve your credit position and free more monthly cash flow. Every dollar paid off now is one less dollar collecting interest if income becomes unstable. Preparation is not about predicting the crash. It is about creating room to act before pressure removes your choices. For investments, separate short-term needs from long-term growth with a bucket system. Keep money needed within 2 years in safer, liquid forms. Money you will not touch for 5 years or more can remain focused on growth. Do not panic sell after markets have already fallen. That reaction locks in losses at the moment. Patience matters most. History shows that continuing retirement contributions during downturns can buy assets at lower prices. Over time, that can work in your favor. But protecting money is only half the battle. The other half is protecting the income that supports it. Recessions hit some sectors much harder than others. Construction, discretionary retail, and hospitality often shrink first. Healthcare, education, utilities, and essential consumer goods tend to hold steadier. People still need doctors, teachers, electricity, and basic goods when budgets tighten. If your sector is vulnerable, diversify your skills before pressure arrives. Explore adjacent roles that sit closer to essential work. AI makes this cycle different because companies under pressure cut costs quickly. Automation becomes more attractive when revenue falls. White-collar work in writing, analysis, and programming is already facing pressure from faster AI tools. In a recession, that shift may accelerate. Build skills that are AI-adjacent, automation-resistant, and useful to the business. Understanding both the business and the tools can make you harder to replace. Build your network now and solve the problems others avoid. Those moves protect your career in a downturn and raise your value in a strong economy. The data shows elevated risk, not certainty. Prepare either way and subscribe for the next look at AI-driven jobs.